What happens when one of the most respected names in luxury motoring actually hits a wall? When a badge that once symbolized German precision starts turning heads for all the wrong reasons? Well, Porsche's boardroom drama is no longer behind closed doors. The CEO has officially stepped down, sales are collapsing, profit margins have cratered, and investors are panicking, quite rightly. So stick with me for the next few minutes because we're unpacking how a world famous automaker went from record breaking performance to full blown crisis mode. And by the end of this video, you'll know exactly what went wrong, why the successor faces a nearly impossible task, and what it means if you're buying into the prestige of the Porsche brand today. So for years, Porsche has represented the perfect blend of luxury, performance, and profit. It wasn't just a brand, it was a statement. But behind the glossy marketing and the iconic 911 silhouette, well, the financial engine has been misfiring for months. Declining sales, shrinking profits, and rising costs have turned a powerhouse into a full-blown liability. Now, the man at the center of it all, Oliver Blume, wasn't just the CEO of Porsche. He was also running Volkswagen Group at the same time, and he was trying to juggle two titanic companies with vastly different challenges. And according to insiders, that's exactly what triggered this downfall. Too many fires and too few hands to put them out. And it wasn't just about one bad quarter either. Porsche's problems have been building now for over a year. The company began reporting declining deliveries across almost every major market, quarter after quarter, while profit margins, once north of 17%, well, they plunged into single digits. The magic formula that made Porsche the envy of every single car maker on the planet suddenly stopped working. Now, analysts have been asking the same question for months. Whatever happened to Porsche? And the answer is, it's a mix of overreach, timing, and denial. The company's long-delayed electric transformation has backfired spectacularly. And Porsche had really big ambitions. It literally poured billions of dollars into EV development, even planning to manufacture its own batteries. But it quietly cancelled those plans when the numbers didn't quite add up. Meanwhile, cost-cutting measures start to ripple through the company. Thousands of jobs were quietly axed, product launches were delayed, and new model development slowed to a crawl. The luxury automaker that prided itself on engineering excellence began to look like a company in survival mode. The final straw came when Porsche slashed its profit and delivery guidance for the fourth time this year, something that it had never ever done before. And obviously, investors were furious, and board members reportedly lost confidence in Blume's leadership. Now, behind the scenes, the Porsche and the Piech families, who still hold enormous power within the Volkswagen empire, made the call. It was time for Blume to go. Now, the official statement called it a mutually agreed early departure, but obviously anyone following the situation knows that this was a forced exit. And the damage goes far beyond one executive's reputation. Porsche's sales have now fallen for 3 consecutive quarters. During the third quarter alone, deliveries dropped by 21% worldwide. Global shipments fell by 6% overall to just over 66,000 vehicles. Now, for a brand that once couldn't build cars fast enough to meet demand, that's catastrophic. Now, the worst hit came from China, a market that used to be Porsche's golden goose. Once upon a time, Chinese buyers lined up for months to get a Cayenne or a Panamera. Now, they're turning to domestic electric brands like BYD, which are delivering similar or even better performance for half the price. The new Zeekr 001, for example, offers nearly 1,000 horsepower, 820 kilometers of range, and a faster charging than any Porsche EV, all for around 38,000. And in case you don't know, that's less than half the cost of an entry-level Taycan. And it's not just China. Porsche is also losing ground in the United States, where sales are down 5% year over year. Tariff pressures, production delays, and a price strategy that's so out of touch with market realities, they're all eroding customer confidence. Take the new Macan EV, for example. Now, that was Porsche's supposed volume savior. Now, let's not forget it's an excellent car, but it costs 30 to 40% more than an outgoing gasoline version. And consumers are simply refusing to pay that premium, especially when the competing brands like Tesla, Rivian, and Polestar offer comparable specs at far lower prices. Porsche's premium has always been about perceived value, but when that value no longer feels justified, well, even loyal buyers start to look elsewhere. Now, Blume's leadership wasn't just stretched, it was fractured. Running both Volkswagen and Porsche simultaneously was never ever going to work. Each company needed a dedicated leader with a singular focus, but instead, important decisions got delayed, projects were postponed, and accountability totally disappeared. Now, according to insiders, Volkswagen's executives became increasingly frustrated with how long Porsche took to adjust its failing strategy. And it wasn't just the EV rollout, it was the total lack of direction. The company seemed unsure whether to double down on combustion engines, accelerate its EV push, or even find some hybrid middle ground. And that confusion cost Porsche both time and trust. Now, enter the new man who will try to fix this mess. Hello, Michael Leiters, the former CEO of McLaren and a long-time Porsche veteran. Now, on paper, he's a really strong choice. Leiters spent over a decade at Porsche before joining Ferrari as Chief Technology Officer and later went on to run McLaren. If anyone does, he totally understands the DNA of performance brands better than almost anyone on the planet. But the challenge ahead of him, well, it's monumental. He's inheriting a company whose profits are down more than 90% since last year, whose stock price has been cut in half, and whose brand image is teetering between legacy and irrelevance. Now, Leiters has called the role the most difficult job in the auto industry, and he's probably right. Meanwhile, Blume isn't completely gone. He's keeping his position as CEO of Volkswagen Group, but analysts are already questioning how long that will last. After all, the collapse at Porsche has exposed deeper issues within VW's wider strategy. The group's battery ambitions have been scaled back. Its software division remains in disarray, and its EV rollout lags far behind both Chinese and American rivals. For now, the public line is that Blume will focus on stabilizing VW, but behind closed doors, shareholders are debating whether a broader leadership shakeup might be next on the cards. The truth is, Porsche's crisis reflects a larger reckoning for all German automakers. See, for decades, brands like BMW, Mercedes, Audi, and Porsche defined what luxury actually meant. But in 2025, luxury isn't just about leather stitching and badge prestige. It's about innovation, range, efficiency, and smart technology. And meanwhile, Chinese manufacturers, well, they've mastered the art of offering premium performance at mainstream prices. And guess what? Buyers have begun to notice. The era of paying double just for a German badge, well, it's coming to an end. So what does this mean for you as a buyer? Well, it means the landscape is shifting. A few years ago, Porsche ownership was considered bulletproof, unmatched quality, resale strength, and brand status. But now, the risk-reward equation, well, it's changing. If the company can't stabilize its EV costs, regain profitability, and rebuild buyer confidence, then Porsche's vehicles may start depreciating faster and maintenance costs could rise significantly. Now, in the luxury car world, perception is everything, and there's no doubt that Porsche's image has taken a huge hit. Even long-term owners are starting to wonder if the brand is losing its magic, but still, all is not lost. Porsche can recover. but it must execute a near perfect turnaround. First, it has to fix its pricing. You simply can't charge supercar money for performance that competitors offer at half the same price. Second, it needs to regain control of manufacturing costs, and that can possibly be done by moving some production out of high-cost Germany. Third, Porsche has to find its EV identity, not just build electric versions of existing models, but design cars that redefine what a Porsche EV should actually feel like. Now, the Taycan was a good start, but not enough. And finally, it needs leadership stability. Constant executive turnover erodes confidence, both internally and among buyers. So for now, the future of Porsche sits on a knife's edge. Sure, the brand is iconic, but history shows that even icons can fall. The difference will come down to execution. So can Michael Leiters do what Oliver Blume couldn't? Restore Porsche's performance both on the track and in the balance sheet? Well, only time will tell. So if you're serious about staying informed on what's really happening behind the scenes in the automotive world, just hit that like button right now and make sure you subscribe so you never miss a single update. We're tracking every major shift in the global car industry, from collapsing luxury sales to EV revolutions that are reshaping the market. And comment below, do you think Porsche can turn it around? Or is this the beginning of the end for Germany's most famous sports car brand? Now, I hope you enjoyed watching this nearly as much as I did making it. And I'll see you, my fellow Porsche lovers, on the next one. Have a great day.